Hi, this is Ray Evans with the Pegasus team at Infinitas Wealth Counsel. And we're in the first quarter of 2025, and obviously it's been a lot of fun the last 2 years market-wise. And the S&P 500 and the broad indexes in the United States have had terrific returns, over 20% each of the last 2 years, followed by a tough 2022. Following a tough 2022, down at 1.25%, which a lot of people kind of forget, ending up 19 down in 2022. So as we sit there after 2 good years in a row, there's a couple things to maybe be thoughtful of. One is the valuations of different industries and different sectors in the stock market. And certainly the excitement in the last 2 years over technology and artificial intelligence specifically has driven tremendous returns in a lot of technology stocks, a lot of chip stocks, those kinds of things, to the point that it's important to maybe get a little bit of a historical perspective moving backwards. And I know a lot of clients are sitting there saying, okay, we haven't had much volatility the last 2 years. What's normal? What's sort of been the norm going backwards? And I think this chart's pretty helpful. On the left side of the page, you'll see the Standard & Poor's 500. 500 big companies in the United States that you predominantly would know the name of. And the Dow Jones Industrial Average, conversely, is only 30 names and predominantly industrial companies. But it is pretty interesting to note what's normal, quote unquote, regarding declines in the United States and in the stock markets going back many years. So this goes back to 1942 in both cases, and the data is pretty darn similar. A 5% decline in either of the markets, actually it's pretty normal, happens about 3 times a year, and it typically lasts about a month and a half in both cases. A 10% decline is much more normal than people probably think. Happens about every 15, 16 months. It usually lasts about 3 or 4 months at a time. So minus 10, very normal. Minus 15 happens about every 3 years. I mention that because the last minus 15 we had, 2022, so we're really thoughtful regarding new dollars going into stocks and the overall allocation that a client has between stocks and bonds. And then a 20% decline, which that's our definition of a bear market, happens about every 5 years, usually lasts for about a year, but it doesn't typically last very long, and the resulting uptick obviously pretty dramatic. So to have those kinds of declines happen, have the market still average a double-digit return over long periods of time is pretty stout, and that's the main reason that people invest in stocks, because of the upside. If you'd like a copy of this page, I think it's pretty helpful, ray.evans@pegasuskc.com. I'll get that in your hands. Thanks very much, and hope you're doing well.